Welcome to our webinar, and thank you for taking the time out of your busy day and holiday season to join us. We're in the Chicago area, and I see that we have attendees from all over the country joining us today. Welcome. We're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this trading webinar today on "'Tis the Season for Puts, Calls, and Crypto," where we're going to dive into option trading strategies on cryptocurrency stocks. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. The session today will last approximately 1 hour. Our speaker will talk for approximately 45 minutes, and then he'll answer all your questions the last 15 minutes. We ask that you look now on your screen to locate the Q&A box. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And to tell you a bit about eOption, as our name implies, we're a brokerage firm that specializes in stock and options trading. We offer you some of the lowest rates in the country, including zero commission on stocks and ETFs, and options just 10 cents per contract. And you can also trade on our powerful trading platform and mobile app. Our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for over 45 years. He created his ideal trading company that caters to serious traders and those who have a passion for investing. At eOption, we support trading education, and we encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. You can go to youtube.com/eOption and take a moment to subscribe right now. And if you subscribe, you'll also be notified as soon as a copy of this recording is available. We also encourage you to visit our website at eoption.com, and you'll find all kinds of educational material as well as our past webinars and videos. And I'd like to turn our attention to our speaker now, Teddy Keckstedt. Some of you may recognize his name from past webinars he's done with us, and we'd like to welcome him back. He's a professional trader and has over 30 years of trading experience. You'll see that he's very passionate about the markets and educating others. He's currently president of Forex Trading Unlocked and the author of the book, High Probable Japanese Candlestick Patterns. So without further ado, I'll turn it over to Teddy Keckstedt now. Thank you.
Thank you, Gina, and hello to everyone, and thank you for taking our time out today to join this webinar. So I'm going to skip past what Gina just said and get ready. All you bulls and bears out there, we're going to talk about cryptocurrencies and puts and calls and options. Before we get into it, we just want to show the eOption disclaimer, just to remind you that this webinar is for illustrative and educational purposes only. We can skip past my disclaimer since it's basically the same thing. Okay, the parts. So we're going to talk about stocks. The underlying assets today are all going to be in the cryptocurrency space. We're going to talk about call options. Call options are the right to buy an asset at a fixed price. In this case, it will be cryptocurrency stocks. We're also going to talk about put options today. The put option is what gives you the right to sell an asset at a fixed price. And those obviously are going to be all crypto stocks as well. So we're going to get into the intricacies of what those prices mean and the strike prices. And we're also going to get into the length of time before option expiration. Okay. We're going to also show you how to integrate put and call option strategies into your trading plan, especially a lot of you want to know how you can break into the cryptocurrency space, and maybe you're not as prone to run into a lot of some of the newer companies and put your money into the cryptocurrencies. You want to go with more of the regulated institutions. We're going to show you how you can do this, especially through the equities and options markets. All right, what is the proper way to manage the options before they expire? So we'll talk about the different types of trading plans and situations that you might encounter. So we're going to show you how you can take advantage of directional option trade setups as well. Okay, so let's explore option strategies for crypto. All right, so how do you make money and lose money? So just as in any other this is very similar to the normal equity investing and stuff. When you buy a stock or whatever the asset is and the market goes up, you profit, obviously. When you buy a call and the market goes up, you profit also. When you buy a put and the market goes down, you profit. So now you know how you can make money. When you buy a stock or whatever the underlying asset is and the market goes down, you lose. Most people get that pretty easily. The same as when you buy a call and the market goes down, your risk is defined, but you can lose all the money that you had put into the option potentially. Now, when you buy a put and the market goes up, the same thing also happens because the market's going against your position, but your risk of loss is defined. So now you'll notice that when I mentioned both the call and the put, your risk of loss is defined, okay? When it comes to a stock or an underlying asset, unless you have a protective stop in the market, your risk of loss is up, well, obviously at your whole investment potentially as well. Okay, now when you're buying a call, that is a bullish position, and when you're buying a put, that is a bearish position. Now, for those of you that are experienced traders, I know it's a very tertiary review and very basic, but we just want to make sure we don't lose anybody. Okay, so case studies in cryptocurrency option strategies. Let's figure out what to do when you want to buy or sell these different markets. Okay, Coinbase, probably one of the biggest names in the equity sector in the cryptocurrency space that everyone has most likely heard about because they're all over CNBC and other news market channels and stuff like that. So at the time when I produced these slides, I picked the January 21st, 2022 expiration for all of the case studies and examples that we're going to discuss today. Okay, so now as we know that there's all kinds of volatility in Bitcoin and all kinds of other cryptocurrencies, that makes it very difficult for a lot of traders and newbies to the crypto space, wondering, well, what do I put my money in? Bitcoin moves around and it's very volatile. I mean, I come from the S&P 500 pit, and I can appreciate the volatility in the Bitcoin pit because it's our Bitcoin market because it's very crazy, very erratic for sure. So, but one thing you can count on with the stocks and the options we're talking about today is that it is more mainstream. So we're dealing with real companies that exist in the crypto space. There's also a regulatory issue that you overcome when you do and look at these stocks that we're talking about and these options, because the environment is regulated. So these companies that are listed all have to follow certain protocols and what have you. Now, when you look at a lot of the other institutions that are out there in the crypto space, that is not the case, or is not the case currently. So this is a very good way for, like, once again, I just want to remind people that are very hesitant about cryptocurrencies and stuff like that. This is a really good way to start to get into the sector, learn about it, and potentially profit off of it as well. Okay, so as you can see from this chart, the market had been trending lower. The Coinbase topped out in the beginning of November and kept on selling off all the way until when I started this slide. So at this point, if you were bullish Coinbase, you can see that the market's trading at was trading at $265, just a little bit over that. So to purchase just 100 shares of Coinbase for even just the end of the year, thinking that maybe, you know what, we're coming into the holidays and what have you, this market's been taking a little bit of a beating. You know, Bitcoin is stabilized, so most of the other altcoins out there and what have you in the industry, maybe Coinbase is going to benefit from a lot of trading and what have you. So, because remember, Coinbase is an exchange for people to buy and sell the different cryptocurrencies. So instead of having to learn about all those coins, you can invest in Coinbase. Now, however, this is a very expensive position at $265 a share. It gets very expensive if you want to put a big investment on it or try and capture a big move. Now, as you can see, when this market topped out, it was just over $360. It sold off over $100 within just a period of, what is this? Not even quite 4 weeks, about 3 trading weeks. So that's a big move, and there's a lot of volatility. So as far as price action, if you were long the stock, obviously you would be taking a lot of heat, especially if you had bought this back in late October, early November sometime. So, but with the options, this gives you a way of playing this differently. So here we're going to look at the bullish play, which is just buying this 265 strike price. So basically right around at the market, there's a strike price of $265. So we're going to look at both the call and the put. So if you're looking at a call, that would be once again, gives you the right to buy the stock. Now people worry about, talk about exercising options and things like that. Now, in this case, you don't have to worry about ever being exercised on because you're purchasing the option. You're using the right to control either a bullish move or a bearish play. So let's say that, right now you're looking at Coinbase back when this video was made and you're thinking, well, if I want to buy the stock, I'm going to have to pay $265 a share. However, if the option for the 265 strike price call, which would be pretty much at the market where it was at, in the equity, you would have paid $29.10 for the bullish play, which would be buying that call. So $29.10 would equate to $2,910. Still a very expensive position. However, it pales in comparison to spending the $26,500 to buy the stock. And also, you got to remember the risk involved also is that this Coinbase had already taken a $100 hit. The market is trending lower. You never want to try and pick a bottom. So as far as investing in a stock, it's very likely that you're going to take some heat. But at least with the option, you would know that the most you could possibly lose would be to the $29.10, or which equates to $2,910. So that would be if you bought this strike price right here and the market continued to go lower, especially into expiration. And if it was down at expiration, you would lose your whole investment on the cost of that option. Okay. Now, on the opposite end, if the market goes up, going into anytime into expiration, then this option will gain in value. So that's where the bulls, you have a good way of playing this market, especially like most traders use the 50% rule. So if you look at where this high was right here, and you look at also where this last previous swing low is here, this market came down into the 50% area. This becomes a very typical buying area, or at least a good bouncing point for a typical market, whether it's an equity, a future, you name it, currency, what have you. So if you're looking at, like, once again, with a bullish scenario, or maybe you have a buy signal, this 265 strike price call would have been a really good option to play for Coinbase. Now, on the opposite end, there's the bears out there. So you're looking at it, wow, the stock got hammered $100. Well, I think there's a lot more room to go. Maybe especially if with Bitcoin that was trending lower during this wave down, things like that, whatever your rationale would be for putting on a bearish play instead of shorting the stock, which means you would have to you have a lot of margin that would put up. So then that's a whole nother deal too, because remember, when you buy a stock, the most you can lose is if the stock goes theoretically to zero, you would lose your whole investment. But typically, you always have some bailout point that you'd be able to still retain some sort of money. That's not the case when it comes to shorting stock. You need to have the margin money. It's very risky. And especially like you think about a stock like this, if it sold off $100 in 2 weeks and the way the cryptocurrency market moves, I mean, what would happen if all of a sudden, I don't know, Bitcoin goes to $200,000 in a day, in theory, maybe Coinbase, all of a sudden that stock would instantly explode, to, all new highs, within a very short amount of time. So that's where playing short with stock, you don't want to do that unless you're very experienced and you have deep pockets. But this put right here, and this is all going to make sense after this first case study as we move to the rest. This 265 here, almost as expensive as the call option, probably because most likely the volatility and its being on the market was near its lows, that the put is definitely a little bit cheaper. And especially because the market was above the 265 strike price slightly. So 28.50 here was the price for this option at the time, which now if you were to purchase this put, which means it would give you the right to sell this stock at $265, but don't worry, we're never even thinking about doing that. So just because, like I said, you don't want to shorting stock takes a very sophisticated investor and a lot of capital. We're not talking about exercising anything today. We're showing you how you can capitalize off of just the options on these stocks. So 2,850 would be the money that's at risk should at expiration the market be above the 265 strike price. Okay. Now, if it is trading lower, like let's say this trend continued, and let's say it didn't even have a big sell-off, but it started to come back to where these lows were down here around $220, $230. So only another $35. You would be able to sell out the put option at a profit when it reaches this down into this area before expiration. So now remember, at the closer you get to expiration, especially let's say in the case of a put and it was trading down here, let's say 230, 220, instead of waiting till expiration and seeing how much lower it could go, you probably would want to take the profit on the option. And conversely, the same would be for if you were a bull in this market as well. And let's say that the market, you were buying into a true bounce area here for Coinbase. And then let's say somewhere between now and the first of the year, you get a rally that gets you up to this 320, 340 area, not up by the highs, but at least a nice little bounce from where it's at. That would be another reason also to sell out that call option. One of the reasons being is that the closer you come to expiration, you've already lost all your time decay. So the pricing in the option, and we're not going to get into all the Greeks, the pricing is really only the difference between where the market, where the strike price is, which is this 265 level, whether you're buying the put or the call, and where the stock or the equity is actually trading at. So when it comes to that, the difference, for instance, here from 265 to 320, you would have this $55 premium in your option. Okay. Whereas it will be the opposite. If it was a put, if the market was lower and you held a put, and let's say it was down at 220, you would have a $45 premium on the put. Now you wouldn't have any time value left, but you would have that premium from the distance of where the market's trading. And that's what we're looking at today. Is you want to catch a market move and take advantage of a market move with a low risk way of doing that, which is what options gives you, that power to do that. It gives you flexibility. Now, I'm not saying you wouldn't hold it till expiration, but pigs get fat and hogs get slaughtered. If you've already, unless you have a certain price objective, like for instance, here's where you may want to hold it till expiration. Let's say you buy a call here, this 265 here, and the market screams to all new highs, and we're trading, it's now January 18th, January 15th, somewhere around that. There's only a few days left before expiration. It's trading so much higher. Well, you may want to just roll the dice then and see where it settles on expiration, as long as you don't think that there could be a sell-off, which you never know. Don't try and time the market. Now, if you had a price to objective of say $425 and you hit when you were close to it, maybe you'd want to hang on to it, but once again, I would say if you're close to expiration and you've almost hit either a price target or you've gained a significant move and you're profitable in that trade, get out of it, because no matter what, once again, the closer you get to expiration, the volatility risk and directional risk that you could incur will outweigh any potential profit typically that you're going to have as far as continuing momentum. So now let's break this down real quick. So Coinbase coin, you are bearish to underlying asset. We use the 265 strike price as our base for the put. The expiration was out to 1/21/22, so January of 2022. The cost once again was $28.50, and which would have been a total of $2,850. And if you were bullish, you would be buying the underlying asset, or you would buy the 265 strike price call. Okay, so your expiration once again would be the same, and your cost would have been $29.10, which equals $2,910. So now let's look at a couple other examples and start to get things looking a little bit clearer. We won't be so wordy now that we got the basics down. Okay, HUT8 mining. So another good thing is, besides the fact that we talked about Coinbase, we're going to talk about some different companies in the crypto space you may not have heard of. HUT8 mining, symbol HUT, happens to be one of those companies. So they have a lot going on, obviously, in the technology sector of cryptocurrencies. I'm not going to get too in depth on that. That's not what this webinar is about, but this is a company that if you're looking at crypto stocks, this is one to at least put your eyes on. Now, the last one was the Coinbase, very popular. That's why those options are very expensive. It's not just because the stock is at 265. It's because there's a lot of volatility and a lot of interest in those stocks. When you get to something like HUT8 mining, well, now it's almost like looking at Coca-Cola, or something like that. It's not sexy. Everyone knows it's out there, but who looks at it anymore? Even though Coca-Cola is not going away and it's one of the biggest companies in the world, right? So the option pricing gives you value. So instead of risking and starting out with Coinbase, like I would say Coinbase would be for your investors or traders that obviously have deeper pockets and are much and have the ability to where it's every risk is all relative, where it doesn't hurt them or affect their accounts as much. Smaller traders or those who are just beginning and learning how to do these things, this would be the better way to do it because you're still going to have very good price movement. Okay, so remember when we looked at the last example, so this obviously in the crypto space here, we started to see it topping out in the beginning of November with the trend then lower going into December. Now let's look at this thing. So I used the market here was trading at $9.37. So I used the near strike price $9 option. Okay, so we're going to use this for either our bullish play or our bearish play. Now, the nice thing about this is there's more room to the upside than there is to the downside, considering that the equity was trading just over $9. If you have the $9 put, which gives you the right to sell, or you're basically being short the market, there's not a lot of room to the downside. So if you're bearish, though, going into expiration, or maybe you think that HIVE mining and there's more than one reason why this trend is lower, or you're one of those people who are just contrarian to the crypto space. Like that's the one thing you're going to have going on moving forward, especially in the crypto space, is you have opportunities for all the non-believers, just like the believers. It's a little bit different take than in the normal markets. That's why we like talking about what we're talking about today. These are real companies, they're regulated, the options market is regulated, the pricing is all fair and decent. And that's something you want to think about too, is that, instead we're just like in any other equity, like I mentioned, Coca-Cola, HIVE mining, when you buy that stock, you're getting a fair spread as far as where the bid and the ask is. Also in the options, trading the options on these stocks, you're also getting a fair spread. It's very tight, it's liquid, and you're not getting, basically incurring excess losses or reducing your winners because of the fact that getting in and out of the trades is very expensive. So that's something you also want to take into consideration, is that the options and the equities that we're looking at today that you can trade through eOption or invest through eOption give you more bang for your buck than you're going to get if you go into, once you get outside of that regulatory boundary with the other companies and things like that. So these are things you definitely want to consider moving forward. So once again, here we have the bullish play for the $9 strike price. This gives you lots of wiggle room here, because think about this. We already were here at $17. We came down to $9. Remember, I told you about the 50% rule. So if we go back even just to this rule here, like basically around 8, you're looking at $9. We already cleared that out. So for you bulls, or those people who look to take advantage of potential just corrections, this market was in a very good buying area as far as those different variables are concerned. So once again, we're using the January 21st, 2022 expiration. The $9 strike price call for this market was priced in at $2.12. Now this is totally different. This is only a $212 option, much cheaper than the $2,000+ options we were looking for in Coinbase. Ironically, think about this: the charts for Coinbase and HIVE mining, very similar. Now they're not the same market. They're not always going to go up and down simultaneously, or or trend the same. However, right now they seem to be doing that same thing. So if you had this same outlook for Coinbase, but you want a little more bang for your buck, this is the way to do it, because you can trade more options in HIVE mining than you can in Coinbase. Okay. So that gives you more flexibility. So as we started out with a very expensive case study example, now we're showing you how you look at some of these other stocks in the same sector, where you can obviously invest in them. Where right now, if you wanted to buy 100 shares, it would cost you $937, but it would only cost you $212 to control the option going into an expiration of January 21st. Okay, so now we have the bearish play. That's the $9 put strike price. This had an expiration, obviously, of 1/21/22 as well, with the cost of $175. Okay, so now let's take a look at what this would do. So with this one here, It costs you $175. You do have a potential to follow through in the trend right here. Okay. And definitely because you're close to these lows, those who are bears would be like looking back here and saying, okay, this market's been free falling for almost a month. And look at where it's bobbing, coming near. It's coming to a gap right here on this chart. All gaps typically get filled eventually on any chart. So right there's a target price for an oversell, you know. So the reasons to be a bear in this market, even though we highlighted some bullish reasons, are totally there. But remember, to the downside, there's not much room. The stock's only at $9. How much does it have to go down? You know, I mean, go to zero, obviously, but they can only go $9, right? That's the highest potential you would get out of a put option, which would still be good, you know, because you would get a $9 premium on your option should it go to zero. But to the upside, think about this. If it did rally into expiration and just came, if it went up to near the highs where it had fallen from originally, you have almost a $9 move on the call play. So the cost of the put is $175 with an unrealistic expectation as far as how far you can get out of that play. Now, I'm not saying that the bearish play wouldn't have been the right play in this situation. In fact, right now, HUT mining is trading at $8.24. So, which actually since then it's basically gone sideways and just a little bit lower. So your bearish play right now, you would be slightly up on that one because you have time left and you're below the strike price. The call, however, you would only be down slightly because we're just above. Like I said, we're trading at $8.24. So the market's $1 lower than when I did the example. Okay, so let's review this real quickly once again. So if you were bearish on the underlying asset, you would be buying the $9 strike price put. That was near the money where the market was trading. Once again, we had the January 21st expiration. The cost for this put was very, very nominal for that time frame, for a month and a half, just over a month, for $1.75 or $175. Remember that the cost of options is always times 100 multiple. If you were bullish, the underlying asset HUT 8 right now, which given the time frame and now considering since the example I told you how now it's been going sideways, maybe these equities are actually bottoming. So the bullish plays may have been a good idea. It may still be a good idea. So the $9 strike price call is what we were looking at once again. January 21st expiration. This one was a little bit more expensive, the $2.12, which is $212 for HUT mining. Okay, so once again, just like we're teaching you how to take advantage of these stocks, these crypto stocks using both puts and calls. Take a look at these as we move forward, you know, in time, because most of these companies are very new. And you'll see that as we start to get through some of these other examples, like Coinbase, luckily already has a little bit of a track record, but HUT mining hasn't even been out that long. So don't think that just because this is a cheap stock now, also it could be trading at $300 a year from now, and all of a sudden its option pricing is much higher as well. So I'm not saying that, telling you to obviously buy HUT 8 mining or look for it to go there, but it does have those potentials. This is a newer company. So all these companies, when you think about Coinbase, I don't remember what it came out with at, but I think it came out at like, I think $60 a share or something like that. And now look at it. So, you know, you can't just think that, you know, Coinbase and HUT mining are in the same category yet because of the length of time that they've been around. Now we have HIVE Blockchain Technologies. Here's another one that took a nice little hit. This is also a very reduced in price stock. So now this one hasn't been around that long either. Okay, now it topped out once again, just like the other ones. And this one has had a lot of volatility. You can see it would topped out just above $5. And now it's trading, at the time, it had been trading at $3.11. So, and right now, let's see, where is it at? It is at, right now, it's trading at $2.70. So right now it's just slightly lower than when I did the example. Okay, so in this case, the market was at $3.11. So the near strike price option was $3 that I looked at with the same expiration. We're using it for all these examples. So the bullish play would be to buy the $3 call strike price, which currently right now the market is just a little bit lower. So it would be slightly down on this position. So at the time I was looking at this, the ask was 80 cents. Now that would be a total of $80. Okay, so now that gives you the right to control this equity once again till January 21st expiration. So if this market here, now this one here is actually making a newer move low today, but it seems to be bottoming. It seems to be basing just like the other two examples that we looked at as far as how the equity, the stock looks now. So if it's bobbling right around here, and it does start to base right here, this call was definitely, I mean, for $80, that's a lot of bang for your buck for something that you have the potential to easily get up to. Probably if it just had a 50% return retracement, somewhere at least around $4 to $4.50, somewhere in this area right here on a bounce, which isn't that significant of a move. You think, you're like, oh my gosh, Teddy, you're only talking about a little over $1 move. Well, a little over $1 move is big when you're trading at $3.11. You know, everything is all relative. So don't let the big numbers scare you. And if they do, and the little ones may seem much easier to you, everything is relative. Just remember that. Okay. So, and then now in this example, same strike price, our put would have been 65 cents. So that's only $65. Now, once again, just like the last example, see Coinbase, there's a lot of room to the downside when you're trading at $265. Well, you buy a put in that and it gets slammed. And I mean, if it already broke 100, it could break 100 more, you know? So, I mean, I remember plenty of companies in the past where lots of brokers and the pundits were out there. Well, if you liked it at $80, you're going to love it at 70, you know? And the next thing you know is people are making wallpaper with the stock certificates because the company's out of business, you know? So, so anyhow, remember that can happen, especially these companies too. These are all brand new. We don't know how viable their technology and how long they're going to last. But there's also another turnaround for the positive side for your bulls out there. What happens if HIVE Blockchain all of a sudden gets absorbed by Google or something like that? What happens to you? Let's say you were long this $3 strike price call right here for $80, okay, at the time, or somewhere where it's at right now. Since it's lower, it will probably be right around a little bit less than the same price because volatility seems to have dropped. So let's say for $80, you happen to be long whatever number of calls. And then between now and the 21st of January, all of a sudden Google or Amazon says, we're going to buy HIVE Blockchain Technologies for $30 a share. Boom, the stock gets locked at 30. At that point, you're golden. You dump your calls because you can't buy the stock anymore. I mean, you could exercise it and sell it, you know, you'd be rolling it to the company. But the easiest thing to do would be to sell out the call. So that's one thing where you want to look at when it comes to a lot of these stocks. And it's why the options give you a really good bang for your buck, as well as think about this. Remember how I mentioned how shorting these stocks is not a good idea. Using the options is a safer way. A lot of these stocks are buyout candidates. So I'm not saying that's going to happen tomorrow or in the next couple of weeks. It could be a couple of years before any of these companies get bought out. But that is the migration of how this works in industries like this, and any industry, especially as you're up and coming. So that's something to take into account. So this one here, even cheaper example to get into than the last ones. We're giving you options on what kind of options to trade. All right, so we'll review this real quickly. So you are bearish this underlying asset. You buy this $3 strike price put, okay? Remember the January expiration, it was 65 cents or $65. So that $65 would give you the control of that, of the right to either sell and exercise the option, but we don't want to talk about that. We're just concerned about the option pricing. You would rather see the market go down a buck or $1.50 and then sell your put out for more than you bought it for. Okay, so and you would get remember, once it falls below that $3, let's say it went down to $2, you would have $1 right there of price premium in your option price, plus you still have some time value and also volatility that would add to that. But that's for another webinar, which the next one we actually are going to get into some of that. Bullish, you are bullish the underlying asset. Once again, the $3 strike price call, expiration January 21st. The cost was only 80 cents or $80. Nice thing about that, once again, I said very easy. If that was a basing play and you see the bounce between now and expiration to see it hit that $4.50 at least, you know, $1.50 on that one is just as likely as to the downside And remember also, you have always the potential buyout scenario also for these companies. All right, now let's look into Marathon Digital Technology. This is another technology aspect of the cryptocurrency market. So obviously the whole crypto space is all technology, but I mean in the hardware and the actual workings of the gears, I guess if you would say. So Marathon also behaved just like all of these other stocks, having a nice rally up into the beginning of November and then just had a big sell-off. It's kind of funny. Usually the sell-offs happen in October. Well, for the crypto space, it happened in November this year. So, and continued even into today. So at the time, I was looking at Marathon because it's one of the popular crypto stocks that are, well, because there's a lot of crypto companies out there. This is one that's actually regulated. Once again, that's why we like these examples and we're looking at these companies. So the bullish play here, the market was trading at 41.64. I looked at the $41 strike price here. Okay, so this one here cost $9.20. This one not such an expensive option either. Okay, so this one here would cost $920 to purchase the call, which at this $41 strike price, which would mean it'd be a bullish play for you expecting the market to go higher. The bearish play would have been to buy the 41 strike price put, meaning that you want the market to go lower. In this case, the market was trading at an ask price was at $845 or $845 to own that option. Now this one here, unlike the last two, is trading up in the 40s. This one has some room to the downside, and especially with the way this thing is selling off. If it wants to go make these lows, well, let's see, $10 move there. It's not very far to go there. And to be letting you know right now, it actually made a lower move today, low today, and it's trading at 36.76 today. So slightly lower. It's trading right down in this area. So had you taken advantage of the put at this time, you would be up. Let's see, this was at 41.64. Oh yeah, you'd be up exactly right around $5 within just a couple pennies of price premium right now. And the time decay here would only be about a week and a half. You still have another, 4 weeks left before expiration. So this put right now would be yielding you a profit if you wanted to get out of it. Had you bought it at the time, you'd be able to sell it out right now for a profit. Obviously, the call would be a loser. You still have time value left, so that is there, and you're not that far away from the strike price. So it would still be, you have some value, which in this case too, if you, let's say you were wrong, we haven't even discussed that. Let's say that you bought the call and you're taking heat and it's down here. Well, you still would have time to dump the call, sell it back out, right? And you would only lose the difference between what you paid in this situation, $920, and where you would sell it out today, for example. So in that case, you know that once again, your maximum risk, if you were to hold this to expiration and the market went lower, this would be $920. Same. The opposite is here for the put side. If at expiration the market is above this $41 strike price, this $845 is the most that you could lose. Okay, so now within this case, the $845 would be it would be higher because you have $5 of price premium. So where you would have lost on the call, the put would have a gain. So you would expect probably a few dollars of difference in that because there's still a lot of time, and volatility actually has been kicking up. So we're going to speed through this, a couple more examples before we get to some questions. I know you guys want to have a little bit to talk about here. So the bearish example here, once again, was to buy the 41 strike price put, January expiration, with a cost of $8.45 or $845. The bullish play was to buy the 41 strike price call with an expiration, obviously, of January, with a cost of $9.20 or $920. Oh, that's a misprint there. That's actually not $9.20. That should be $920. My bad. Okay, Square, SQ. Here is another nice tech stock. This one's at a higher level too. Now, this is pretty funny. This is another one that took a hit like Coinbase. This had a high back in October that it slipped off. This one's been trending lower since before the other ones. So this one's really hammering the trend down. Okay, so look at how that move was in just a period of a month. So looking at a chart like this, when this was trading here, the $180 strike price was the level that I chose because the market was at 181.38. Okay, now the market actually is at 168.25. So it's a little bit lower here than it was at the time of the example being created. These options here, a little bit pricier, once again, not quite as much as Coinbase. However, as once again, you can see things are relative. These markets have a lot of volatility, and it's a stock now that's at 180 that was trading up at 280 just a month and a half ago. So the higher the value and the higher the volatility of an underlying asset, whether it's a cryptocurrency stock or Coca-Cola, regular equity stock, or whatever the underlying asset would be, that would also, as when those factors are all put together, your option pricing will be more expensive. So we've given you some examples that are a little bit easier for smaller traders and smaller investors to get started in and still participate. And then we have some good examples here for those of you that have obviously deeper pockets and what have you. And once again, it's all relative. So don't think that because I'm giving you an example like this, you can't participate, right? Okay, so bullish play here, the 180 strike price call, same expiration, costs $16.75. So that's $1,675. But that's a little bit better than putting out over $18,000 to buy 100 shares of stock. Not that it's a bad investment, but this thing has been trending lower and lower. I don't know. Catching a falling knife is not a good idea, no matter whether you're playing a game or trading the markets, So this is where I would say before I would want to buy this stock, I would look at the options and layer myself in there. Now, obviously you could exercise. We're not talking about exercising. We're just talking about buying and selling of options to profit on the direction of market moves. In this case, you would be locking in this 180 strike price, looking for a rally. And considering how much this market has been beaten down, let's say that this did bottom right now, or is bottoming, even though it's a little bit lower today. It has a good 5 weeks still to bounce. That's with the volatility and the trend that this market has and how much it swings in any given day, let alone a week or so. You have a good most likely, should you get an upside move, you would have a good opportunity chance to catch a move up to 200 to 210 at least, maybe even 220, 230. So on the stock, that would be a very expensive position with a lot of downside risk. You're trying to catch a falling knife, so you might still take a little more heat. The call gives you a little flexibility because you have the time frame that you have. You're paying for that time, but you still have you can have the opportunity to capture market movement. Now, contrary, if you're bearish, necessarily, selling into new lows, it's something people don't like to do. Like, people are always afraid to buy the high and they're afraid to sell the low. Well, how often can you pick a top or a bottom? You should never try and do it. It usually doesn't happen. So just because you sell something doesn't mean that it's not going to go lower. Or in this case, we're not shorting the stock, we're buying a put. Remember, we're not talking about shorting stock. We're talking about a bearish play, which is buying a put, which is the same difference, just without all the risk. You can sleep at night much better with a put on than you can being short stock. Trust me. So now the bear, speaking of that, the 180 strike price put would have been 1535. So we have two more to get through and then we get to the questions. So we're going to skip through this pricing. You've already got the message on that one. Argo Blockchain, which I know a lot of people had interest in this webinar. Now this is a very interesting case. So see this chart? This isn't just empty here because of whatever. This is because this is a new company, or not a new company. It's a newly listed company. Once again, trading at $12.50. This gives you options. Look at the pricing here: $1.95 for the call, $2.20 for the put. So the market was trading at $12.70. I looked at the $12.50 put option. Now here's the other thing is there's not a lot of strike prices. If you were in most stocks, you would have a $12.50, you'd have a $13 and a $12 option. They do have them as you get closer to expiration and in the front months, but they don't have them in the backs. So even on this, when I looked at the example, the next nearest strike price was $15. So you're looking at $2.50 to get long either a call or be short or be long a put. So this was why definitely in this example, it was nice the market was right here. The cost was $1.95 or $195. And in this case on the put, it was $2.20 or $2.20 or $220. Once again, on the downside here, market's at 1250. There's only 1250 that the market can still break. Ironically, though, look at since it's only been out for a few months, it topped out at $21 and it made a low at $12. Okay, so you had almost a 50% correction from the high print in this equity now, and that distance now is all that's remaining to go down to zero. So the downside still has some room in it, but the call, if you're looking to buy the stock, this would be something where the call probably gives you a really good chance to catch a bounce, you know. And irony of it all, let's see, we're at right now here. So the downside here, once again, was $12, but the upside here, let's say we had the 50% bounce like we were talking about before. From 1250, that would put us back up into the around $17 here. This is a really good area because it's kind of where the market came out. There was a lot of consolidation. This would be a good price target area if you were a bull. Now, if you were buying the stock, obviously, you could buy the stock for $1,250, but $195 on the call would probably be a better bullish play than the stock. Once again, the stock hasn't been out for very long. I'm not saying buying the stock wouldn't be a good long-term investment, but I think that if anything in this situation, once again, you don't want to catch a falling knife. There's no real signal, and there's no fundamentals driving any reason why you probably would be bullish. So buying the equity is not a good play. This doesn't mean that you wouldn't be able to catch a bounce or that the stock can't go up. That's where the call comes into place. Now, if you're bearish, obviously there's still room to the downside with the put. Okay, so with this one, we had a 1250 strike price put, which was at $2.20 or $2.20, which would have given you a nice little way to capture a downside move should the trend continue. Or if it's bouncing, which it looks like it may has a good chance to because of all the stocks we were looking at, this is the one that actually did catch a bounce. You are looking, you're looking at a nice little move. So let's get to some questions real quick. All right, so we're looking at short-term options only. We'll be discussing, I'm not sure, I think it will take the moves we're looking for. Okay, so yes, the first question was about the moves. Yes, we were looking to catch short-term moves, especially because we're coming into the end of the year. So you have a lot of what happens now over the next 2 to 3 weeks. We have a rotation amongst fund managers. Okay, so if you have funds that are they're up on the quarter, they're up on the month, they're up on the year, they're looking to take profits on positions that they're up. So there's a good chance that you're going to have a lot of selling. Okay, for one. And then also you're going to have a lot of curtailing. You have a lot of new things where you have a lot of new funds that have come out, especially in the crypto space. All the companies we've looked at, except for Coinbase, have had a very short existence as being publicly traded and being regulated. So as that time grows and as they mature, more and more funds will be buying them. Also, more and more funds are now being set up where they are crypto exclusive. They can do that now because guess what? They have options. They actually get to use the options, which they do, and also have the stocks. So that's something where the markets that we looked at today, there's a very good probability that not just Coinbase, but every single one that we looked at, that the options markets is going to continue to grow in volume as well as the activity in those underlying stocks. What is a crypto stock? A crypto stock is a cryptocurrency industry stock. So anything that deals as far as being a crypto exchange or in crypto technology or in whatever has to do with crypto, that is a crypto stock. Kind of like you have like your staple stock, like Procter and Gamble and Johnson & Johnson. That's that sector. The crypto sector is the cryptocurrency sector. So they are not cryptocurrencies. These are companies, okay, but they deal in the crypto space. Let's see, in your HUT-8 mining example, how did you come up with the January expiration date? Once again, I was looking at these as being examples to trade the end of the year into the new year. We have, I mean, obviously, anyone that's been except in a coma the last year or two knows that we have incredible volatility in the markets. We have the markets on their highs. We have Bitcoin that had come off a nice new high. It seems to be comfortable at this 50,000 plus area, coming off the just under 70,000. And you have all these other cryptocurrencies also. Now, the HUT-8 mining example is because of that sector. When I looked at the different crypto companies that were available, I wanted to hit Coinbase because I knew people knew the name. Argo was one that people have heard. Like I said, it's really recently listed, but I wanted to look at the ones that were one on lots of radars, that two were also involved where they had where you trackable already revenue streams and some other things that just gave them fundamentals. So today we've been talking about technicals. We're not teaching you buy signals and sell signals here. That would be a webinar in itself, for that kind of a thing. So we were just talking about what would be your scenarios and stuff like that. I wanted to give you company names and markets where there's opportunity, where you can see that like Coinbase is much more expensive for your smaller time investor and trader to participate in versus say Hut 8 mining. Okay. So that's why we use the shorter expiration dates as well. Now there are things for longer term expiration. When you talk about longer term expiration dates, that gets into more sophisticated investing. And this is a more beginner webinar that sophisticated traders can gain from, as well as beginning traders. But to go into long-term expirations, a lot of times when you start to use a lot of longer term expirations, you start to deal with spreads and all kinds of layering of and legging in and out of options. These are techniques that you have to be able to be solid in your fundamentals before you even start to even think about doing those things. Let's see, some of these companies are primarily startups. I trust that they are found on the OTC exchange. Are these options available? Yeah, the options are available on the CBOE. So these are not like, there's a whole bunch of cryptocurrencies that are on the, crypto companies that are on the OTC and what have you. But I mean, Coinbase, that's a listed company. That's not in the pink sheet market or anything like that. And there are derivatives at the CBOE. It has a good volume and it has a good option chain also for especially Coinbase and some of those other higher priced options. So they're no different than trading Amazon or Tesla. It's just they don't cost as much, So, and that's another way of trading the technology sector, because those are very expensive markets to trade as well. So let's see, we get to the next one. We still have time for a couple more questions here. Seems like the option prices for crypto companies are high compared to other industry options. This is going to be a two-part answer here. Let's see, my reason is most option prices are about 10%. That is true. Okay, so as far as, so to paraphrase, we had a question here. It's about the cost of crypto options versus options in the other rest of the industry. Yes, in your thinner markets or more volatile markets, you're going to see a higher cost of pricing. But I would say that you're not going to see any difference in, say, Coinbase versus something like Tesla. You look at Tesla and Amazon versus other technology companies that are even the trend and have good volatility. They're not even remotely priced near what the levels that those options are. I mean, I have to say, like, having been in the business for a very long time, I do know some guys who are old ex-CBO guys and still trade options, and most of them, in fact, I would say every single one of them makes the majority of their money writing options. So they're loving the excessive premiums that you're getting in, especially some of these stocks. But you have to have very deep pockets when you're writing these kinds of options, because there's a double-edged sword there. You're already looking at stocks that are so expensive in price that, let's say it's even to the downside, if you have a 50% correction in Tesla and you've been selling calls and I'll have a big load and you're loaded up on calls, you're looking at, on puts, that you sold, you're going to get crushed in a big market slide, so everything is relative. As far as the pricing, yes, you're going to see in the higher flyers like Coinbase a little bit higher premium. But remember when we looked at some of those other ones, as we get down to the cheaper or the lower, not cheaper, but lower price stocks. And I gave you the example of how this is like trading a Coca-Cola. The option pricing is not, and that's where you get your big bang for your buck. Some things are not on the radar. So there's only so much money allocated, or it'll say, hey, a crypto fund may be like, we're trading options on Coinbase, but we're not touching the other ones. Well, if the other ones trend with Coinbase, just like Bitcoin is kind of like, I consider it the dollar index for the cryptocurrency market, if you will, to a degree, not wholly. That's a whole webinar in itself. But think of it like that, where the dollar index, the euro and the pound are the two biggest things. If those things move it, it's going to make those things move. It's the same thing as relative in these markets as well, especially when it comes to the options markets. Okay, let's see. We have, I think, time for two last other ones. Okay, I see here basically eyeballing the candlesticks and not using any. Okay, yeah, this webinar is not about support, resistance, and buy and sell signals. We could do a webinar on, in fact, like my book, High Probable Japanese Candlestick Patterns would be a great one to use examples currently in the market with when those patterns get triggered, what would be a good option play. This webinar was about learning, understanding, finding decent strike levels in the market or where the market's at, and then evaluating what would be a good bull and what would be a good bearish scenario. Remember how we looked at some examples and I'm like, okay, so if you're going to trade the options on this one, the bullish scenario is better than the bearish scenario. There's not much room for your risk that you're putting up. So unless you have a valid, real valid reason to sell into that market, or you have a sell signal that you're following and whatever, that's one reason to take that trade. Or you do the right thing, which is you walk away. You don't take the trade. For instance, if you're bearish and there's not much room in the bearish trade and all the money is in the opposite end, you don't take the trade. You got to remember when you don't just put on a position just because you want to put on a position. So for these examples, I couldn't control where these markets were at. They were at where they were at. So I was just looking at a line in the sand. If you're bullish or if you're bearish, this is the cost, and this is how you could look at it as far as how can you manage it and what can you look forward to, So, but yeah, as far as that's something that's on our list of topics is integrating, getting more into the actual how you pull the trigger with the platform and stuff like that, entering the actual option trades, and also why you would do it. So, but today's lesson is not a webinar in support and resistance and technical analysis. But read my book, High Probable Japanese Candlestick Patterns. It's all in there. Let's see. Would you ever sell puts on these stocks? Okay, now selling puts, remember, this was all about buying options. This will be our last question. Selling options is where you have unlimited risk. Well, except for if for instance, you sold, well, if there's unlimited upside for the equity or stock, you have unlimited risk. To the downside, you have only as far as the market could go. That would be your risk on selling options. But yeah, as far as selling puts, that's a naked position. That's for advanced traders. That is the same thing as being long, So there's other ways of being long that I would suggest before you sell puts. And I'm not saying that selling puts is not a bad idea. I've sold options before, and like I just told you, I know people that do it. That's all they basically do. But you have to have deep pockets and be very sophisticated and watch what's going on. Okay, so that is that for that. So let me just turn this slide once again, give a plug before I turn it over to Gina. So if you get a chance, Forex Trading Unlocked on YouTube, subscribe and check out my channel. It's got all kinds of videos, and also about if you want reasons to buy and sell a market. They work in all kinds of markets. My patterns, High Probable Japanese Candlestick Patterns, available at Amazon.com in paperback and Kindle versions. And now I would like to turn the mic over to Gina, and thank you, eOption, and all of you guys for participating today.
Great. Thank you, Teddy. That was very interesting and informative, and lots of great questions. And thank you to all of our attendees today for taking the time out of your busy day to join us. And just a few reminders before we go. A recording of this webinar will be available tomorrow on our YouTube channel. So make sure you're subscribed so you don't miss any of our videos. And that's at youtube.com/eOption. And if you do go to YouTube, when it's published, we will have a special promotion there. So if you open an account, we will give you some free stock. So some free Bitcoin stock, actually. So we encourage you to go and check it out when it's available tomorrow. And just a few reminders about eOption. We do charge some of the lowest rates in the country. It's just $0 for unlimited stock and ETF trades. And options are just 10 cents per contract plus $1.99 per trade. And if you go to www.eoption.com, we have lots of great resources on there that are also free to help you with your option trading. And another great thing about eOption is we do offer a tool called Options Play. It's free if you open an account, and there's no minimum to open an account with us. And basically, it scans thousands of stocks each day that highlights potential option trade opportunities for you. And it's a very intuitive program. So we encourage you to check that out. And you can go to our website and learn more about that. And that's that. So thank you for attending today. We really do appreciate your time. Oh, and one more point. If you like the webinar today, Teddy Keckstad, our speaker, is going to be doing our next webinar as well. And it's called The Mechanics of a Basic Option Trade. And that'll be in the new year. So that'll be January 22nd. Or excuse me, 26 at 1 p.m. Central Time. So we encourage you to mark your calendars, and you can also sign up today and put that on your calendar. So we hope you'll join us. We do try to do at least one webinar a month. So we hope you'll be part of our series. And thank you again for your time. We greatly appreciate it. And we wish you a happy and safe holiday season and a very happy new year. Thanks again. Bye now.